how should investors be thinking about financing in today's conditions?
I think they should. I think they should not concentrate solely on the rate and see what they can do in terms of leverage on price, because the price is going to help you out in the long run, right? So,
Mhm.
and here's just an easy example. Let's say there's a $2 million property, but you can get it for 1.9. That's $100,000, right?
Mhm.
But if I get it at today's just kind of par rate, meaning I'm not buying down some rate, it's just whatever today's rate is, I'm getting into that, right? The difference between that and what the quote unquote rate you think you should be at, if you did that math, again, it goes back to maybe it's only 200 bucks a month.
Most investors think access to capital comes down to the numbers, credit score, income, balance sheet. But what if that is not the real game? What if the biggest deals, the best opportunities, and the fastest path to wealth are not unlocked by spreadsheets, but by relationships? This is your host, Vinki Loomba, and today we are diving into a side of wealth building that most people never fully understand: how capital actually flows, and why some investors always seem to have access while others stay stuck on the sidelines. I am joined by Aaron Marsh, founder of Marsh Lending, who has spent over 3 decades helping investors navigate complex financial situations and access capital beyond traditional banking system. Aaron brings a relationship first approach to lending, helping investors structure deals and unlock opportunities that most people never have even seen. So, Aaron, welcome to the show. I'm super excited to have you with me today.
Oh, thank you so much. I'm looking forward to it for sure.
So, Aaron, today our topic is very interesting: beyond banks, the real estate playbook wealthy investors use. So, a lot of people believe that if they have strong income and good credit, they should be able to access capital easily. But that is not always the reality. From your experience, what are people missing out about how lending actually works?
Great question. So, really, when it kind of dovetails into the topic in terms of looking beyond banks. So, just like as you described, there might be someone who's looking to do an investment property, and they're going to take their credit score and their bank statement and their W-2s, and they're going to go to the bank and they're going to try and get a loan, right? Well, when you get to the bank typically has, depending on what bank or credit union you go to, they have like 3 or 4, maybe even up to 5 different kind of programs that are all kind of part and parcel the same. And they'll do their best to try and fit whatever you're trying to do. So when you think about it, it's you as the investor, but it's also the property that you're trying to acquire. And then if it is like something like, let's say it's a retail shopping center, or it's an office building, or it's multifamily, then there's tenants that are involved with that too. So there's just as much underwriting on the tenant piece, right? Like how long are their leases? Have they always been current? All those kind of things. So they wrap all that up into a bundle, and then they say, okay, here's the 3 or 4 things that you may qualify for. And then depending on the guidelines, and they're always driven by, how do I quickly resell this loan on the secondary market, right? So they're trying to tick all those guidelines based off of what information you're giving them. And if it doesn't tick a guideline where they can easily get rid of your loan, then what happens is then you get a decline, or they're constantly trying to hit the square peg into the round hole where it doesn't necessarily fit, right? It doesn't fit you strategically in what you're trying to do. Maybe the rate's too high. Maybe they're asking too much for a down payment, so it does fit their guidelines. Or maybe the terms aren't what you wanted in terms of like, how long you want it amortized, or is it an ARM product that changes every year, interest rate wise, that kind of stuff. So that's where they'll come to us, and we do more of a holistic approach because we have access to capital, um, and resources that look at things besides that, right? So they do, as long as you're fitting their criteria in terms of like, you can handle this, you have like an experience base, you're not biting off more than you can chew, then they're going to look at, okay, what is the property, is it in good repair, is it brand new, does it need work? Okay, now what about the tenants? How secure are they, or their tenants, right? What is like the last 12 months of rent rolls, if it's like a multifamily place? Or what is the lease agreements, if it's a business that's leasing, an office space or a retail space that you're buying? What does that lease look like? Have they had multiple leases before? What does their business look like in the current environment, right? And so there's a lot more holistic approach. And then they can, with some of these private lenders, capital groups, family offices, then they'll more kind of tailor what a term sheet and what they feel comfortable with from a risk standpoint to what you're trying to do, which it can be everything from highly customizable, or just something as simple as, hey, show us your PFS or your personal financial statement. We need like a couple of other documents, and then give us a copy of the lease, of the tenant that you have. And then they'll say, okay, we feel comfortable enough that it's only 20% down, and we'll lend 80%. Or this one looks a little more risky, so it's 25% down, we'll lend 75. Or it could be the opposite. It could be like, you're strong as an investor, the bank told you no, but that's something that we can come in and say, look, you put 10% down, we can lend 90%. And then do you have an investor that can do like a personal guarantee on the backside? So there's a lot of different um, opportunities and options and resources that we can bring to the table, as opposed to just walking into your bank at the end of the street.
Oh, okay, so you have to bring your complete story to the lender to figure out what the best approach is going to be. And you've been in this industry for almost 30 years, right? So was there a moment when you realized that lending is less about transactions, it's more about relationships? Because I have seen that too, that works very well.
Yeah, and so that's exactly why we built this, because I always thought that there's a better way, right? So we are definitely not transactional based. We're definitely partnership based, and then even in that, we kind of there's an interview process, right? So the interview process is, you're an investor and you're going to multiple sources, right? I'll talk to two banks, I talk to like a commercial lending company, and then I talk to two people like myself. Well, as that person is interviewing us, we're kind of interviewing the client as well. Do they fit into our ideal client profile? Is this something that we can build a lasting relationship with? Or is it someone that's just looking for a race to the bottom? Give me the best deal, I don't care if it's strategic or not, right? And um, so it is very relationship building. And the same thing is, we've worked really hard at building partnerships with all these different resources, right, in terms of capital. And so we want to bring great deals and good clients to them that they feel comfortable about lending to as well, right? So it's relationship on both ends. It's not just you get on some sort of bot loan online, and you just click in boxes, and you never know or meet or talk to whoever's on the other end.
I think maybe a lot of people don't understand that it's all relationship game. So let's talk about
Mhm.
this gap. So why do you think that so many smart investors still struggle to get funding even when they have solid deals?
I think a lot of it is, they need to make sure that they do the homework, that the person that they're trying to get funding with has a lot of different and unique sources, and they have experience, right? So let's say someone is trying to finance a $50 million office building, right? Or medical center. and if they're going to someone who hasn't done much more than, like, let's say 500,000 for a washateria, right? They may not have the access or done those type of deals or figured out, there's many layers that we can, kind of bake into this to get that deal done the best for them. And so I think it's where you start, and kind of what you're trying to look for in terms of homework, and then what is the creativity that the lending side has in options for you, right? So is there an equity partner that can come in? Is there like a joint venture possibly to make this work, where it's a little less, down payment and capital up front from everybody? Or is there something even as unique? This is us as we're continually building our relationship. We were in contact with someone who reached out to us that does this unique product for ultra high net worth clients, that's based off of life insurance policies. So you get a life insurance policy, then you can borrow against that, and then because it's a loan and not income, then you can use it to help purchase what you're trying to do, you know and then the payout comes at the end when the life insurance policy is cashed in. So there's just always unique ways that people have access to playbooks that not everybody has, right? And I think a lot of it is just also back to the relationship building, just, listening to shows like yours, talking to people like you in terms of, like, hey, I met this interesting person and this is the room that they were in, and here's the access to capital, and here's how they structure these deals, those kind of things. And you're like, wow, I never heard of that before. So
You just said the unique product. So you mean by something more customized approach? So can you share with that? How do you think it's a unique product, or how can you customize something for a particular person, whether it's relationship based or no?
yeah, again, it comes back to that little bit of narrative. Like, tell us a little bit about your story. What are you trying to do with the property? What other properties do you own? Is there some way that we can leverage, maybe like putting it all into, like, kind of more of a portfolio of products and cross collateralize? Or is there a way that we can leverage, this other third party that does these insurance policies that helps these people, purchase these without it having to be, just a huge dive into all of their tax returns and all their companies. So we use one client a lot, and he has 17 different LLCs based across tons of auto dealerships that he owns and his family owns. So he doesn't want to go into a bank and drop all 17 of those down. But because we have a relationship with him and we've done things in the past, we can uniquely set up like an LLC, and then we use like just one of them, not all of them, because when you get into like bank underwriting, they want to know where everything comes from, as opposed to just like, what are you using to pay for this? And so we're able to, help him customize whether it's a new property or if it's a new development, or if, they want to buy into a business, those kind of things. You know, Knowing his unique situation and how, best we can, create something new for him.
Hmm. Earlier, you were talking about kind of something similar. You mentioned, you interview people, like you mentioned, you look at the different categories and you create this unique product for them, the loan product that we're talking about, right? And I
Right.
think loan is the leverage is one of the biggest wealth building strategy that we're talking about today. How you
Yeah.
can grow exponentially when you're leveraging other resources beyond your own means, whatever you got. So what I wanted to understand from you is when someone comes to you and what things you look for beyond the numbers, what makes you say that, okay, I wanted to back this person. Like if I come to you with my portfolio, and
Right.
what would make you say, okay, I wanted to back her?
I think the strength of the portfolio, right? Like, what are the things that you've invested in? Are you holding them for a long term? Because we do long term strategies different than short term strategies, right? There's a lot of people out there that have more of a short term strategy in terms of, like, they want to hold something and they only want it for like 3 to 5 years. So then we'll work on a situation where maybe we only do like a, like a 5 year loan that's amortized across 25 years, right? But maybe if you're going to be more long term, then we have products that are with us that, to get your monthly payment down, it's maybe a 10-year loan that's, I mean, a 40-year loan that's amortized and it's interest only for the first 10 years, right? So as you're trying to build up equity in that, and then also keep your cash flow going as you're trying to keep whatever property you have, say it's a rental property, you're trying to keep it rented. So we look at like what your goals and your aspirations, and we also look at like what are different ways to get in this where it creates the most value for you, right? So case in point, we had someone who sold a business in New Orleans. They wanted to buy. They're like, we're going to put this money in real estate. We think now's a good time to buy. We think that, over 5 years, this area that we're buying into is really going to grow. So they wanted to buy a $6 million house, right? And they were just going to pay all cash for it. And so we kind of talked to them and we go, well, that's not really using leverage to you, because now you took this liquid money from the sale of your business and you're putting it into a house. And yes, you're going to get, cash flow from the rental income on that. But then also, you've kind of locked it up and it's not as liquid, because if you need to have access to that, you got, basically two things. You borrow against it, right? Some sort of equity loan or something like that, or you're going to have to sell it, right? And just exit the position. So what we said is, if you're looking for $6 million in net worth growth, why don't you look at $2-3 million properties, put $1 million down on each one, right? And then you keep the balance of, you're using the leverage, you're getting the rentals to cover all of the debt service on it, right? So it pays for the taxes, the insurance, any association dues, and then your principal and interest on your payment, right? And so what we did is we kind of leveraged them into two properties. Now he still has the $6 million in net worth, and he's got two properties that are working, that are growing at the same time in terms of equity. So he's kind of doubling up, and he kept money for, other investments or other things he wants to do, keep it in the market, right? Because the market's really good right now. The market is moving, faster than most things. So.
Yeah, that's a really good strategy, just putting in multiple properties and, getting more leverage. That way your net worth is gonna grow if you do that versus putting all the money down. I think a lot of people do that too because they think they have to pay taxes otherwise, right? If they exit a business, they have a huge capital gain. So if they
Mhm.
do not deploy that correctly, they have to pay a lot of taxes. So what is your approach on that, or what have you learned from your experience on that side?
Um, from a tax standpoint, a lot of people will go into like what they call like a 1031, right? So
Mhm.
they'll put it into a property, and then say that property, let's say, you put $2 million into a property, and then over 2 years it appreciates to 3 million. Now you've grown. Well, you can exit out of that property, take that $1 million in organic growth that you got, plus your $2 million out. Now you're at $3 million. And then, the 1031 laws are kind of, you have to get it into, equal or better, property. So you need to buy like a $3 million, or you can do it as a split as long as you're just, distributing it out as well. Right. And so, then you have two properties growing,
Over
together,
here.
and, it is a good strategy to try and increase your wealth, especially if it's something that, is in a high growth area and you're getting good rental returns that's paying for the leverage piece or the loan piece of those properties. So it definitely works to your benefit. And again, because it's a business purpose loan, you get all those, that first year, depreciation, the from the bonus depreciation, you do a cost seg study on the house or the property, and
Nice.
a lot of times that pays you back for everything that you had to put into it, right? So we've done a few of those recently, and they're at a very high payback threshold, that you get your down payment, your closing costs, and everything that it costs you to get in that back in that first year, right? And so
That's Mhm.
that's another strategy that people are leveraging too, as well, is right, is that then once you get into that property and you own it, then you can take a loan against it because a loan is non-taxable, right? If you need to get cash out of it. So that's another way of accessing cash.
Yeah, that's true. I agree on that. But sometimes, people, they just sit on the sidelines waiting for that perfect deal. Then I'm gonna deploy and then
Yeah, I always say you don't ever really wait on the market. You kind of get into the market, right? Like even today. So today there was a lot of from Fed Chair Warsh, there was a lot of talk, the past few days in terms of like, what are the rates, what are inflation, what is that? And it doesn't look like there's gonna be a whole lot of rate movement now, either downwards or upwards, but there is a potential based on numbers, ongoing oil prices, those kind of things, that there may be like a cause for inflation. How do they deter inflation as they raise rates? So if you feel like now is like a time that rates and prices have kind of bottomed out because we really kind of moved from a seller's market into a buyer's market because there is a lot of areas in the country that have um, some pretty heavy lift on days on market, right? So you might be able to negotiate some things like negotiate, help you buy down your interest rate. Then rate isn't a problem, right? So if the seller says, "Hey, you buy at full price, but we'll kick in points to knock this down," those are some strategies that you can use at your fingertips. Or you offer a very competitive price. The seller may come off their price. Then you got it. Now I'm into this, and I really don't care if interest rates are up a little bit. When I'm ready to refinance, when rates feel like, where they're comfortable, you've had all that organic growth because you bought it at a little bit below market, plus what everything the market has done move forward.
so one thing I caught, you said interest buy down. Let's talk about that too a little bit. How does that work? Isn't that like you're paying up? It's kind of a catch 22. You're paying upfront versus just getting the high interest rate and
Yeah,
going with that. So I would like to
if
hear your
if
thoughts on
my
that.
client, yeah, that's a great question. So we always do, we typically do, we don't try and lock you into a rate, right? We give you
Mhm.
choices. So we'll say for this loan program, say it's a DSCR program, we're not using your tax returns, your personal income, any of that. We're just using the rent and the market value of the property to qualify the loan. So let's say we're into that product and we just priced out a bunch of these with some clients this morning. We'll give you a rate stack of 4 to 5 different rates, right? But also what we'll do, because we're really big on relationship building, clear and transparency. And we'll tell you what is the principal and interest with those. And then if there's any discounts or if it's a little bit higher rate, there may be lender credit that we can get back to you, right? And so, and then a lot of people will start to do the math. And again, like you said, it's kind of a catch 22. You may pay $10,000 because you don't like, I don't know, 7% sounds high to you on an investment property that you have no skin in the game in terms of like, heavy underwriting, or you're not going to you're not going to own it, occupy it. Then you may want to buy down to 6.5 because in your head that sounds like a better deal. Well, if you buy down to 6.5, it's going to cost you this, but your principal and interest for the first 10 years is really, maybe negligible. Maybe it's $250 in a monthly payment. It may take you 9 years to make back that difference. So we tell people, hey, look and do the math. Here's what this costs. The only people that know the rate are you and the bank. No one of your neighbors, no one else knows the rate. And you don't really have to, you just say, I got a good deal on this, right? If someone says, well, what's your rate? Well, I got a good deal on this, right? Because more often than not, when we show customers that, we save them a lot of upfront money because they see the small difference in monthly payment based on the huge chunk of money it costs to get a rate down, like a buy down. Now, in our earlier example, if you can get a seller to kick in a point or two towards your rates, then you do that, right? Then you want that. Or if you can get them to give you some sort of backstop for the first 6 months, they're willing to make sure as you're growing this property or something like that. So anytime you can get a personal guarantee from, on the sell side, you try and take that because that's more or less kind of like free money. So
Interesting. So let's talk about right now, with the current interest rate environment, there is a lot of hesitation in the market. How should investor be thinking about financing in today's conditions?
I think they should. I think they should not concentrate solely on the rate and see what they can do in terms of leverage on price, because the price is going to help you out in the long run, right? So,
Mhm.
and here's just an easy example. Let's say there's a $2 million property, but you can get it for 1.9. That's $100,000, right?
Mhm.
But if I get it at today's just kind of par rate, meaning I'm not buying down some rate, it's just whatever today's rate is, I'm getting into that, right? The difference between that and what the quote unquote rate you think you should be at, if you did that math, again, it goes back to maybe it's only 200 bucks a month. You got $100,000 up front in kind of market equity that down the road, if you ever need to, refinance, you'll have more leverage because you have more equity. Or if you sell it, you'll get that $100,000 back and then some, right? And buying in today's rate, I think just too many people focus on rate and not enough on negotiating sales price, negotiating, different terms with the bank. Can we do 10, can we do interest only for 10 years? But if you amortize this against 40 years, then that lowers my payment, and then I can, if it's really close in terms of, cash flowing versus not cash flowing, until you hit stabilization, those kind of things. I think those are the things you really should focus on. Rate, unless it's a super high purchase, those small incremental differences, the payback period tends to be extended out many years.
Mm. Let me ask you this. One thing I have noticed after interviewing many, many successful entrepreneurs, investors, and I've noticed that you really build wealth when you're looking for something perfect. But you build wealth because somewhere along the way, the mindset has changed, or you think differently. So, looking back on your own journey, what is one belief you once had about money, lending, or investing that you now completely disagree with? And share with us, what changed your perspective?
I think it goes back to, and it's simple, and it's not a situation where you have like a lot of like oh my gosh, that's the secret formula and that kind of stuff. I think a lot of it is just consistency and then time in the market versus timing the market, right? And so, and I know you've heard this a lot, but everybody that's kind of waiting on, hey, let's say you're a W-2 employee and you work at a company and you're going to get a bonus check in December at the end of the year, right? You're waiting on that bonus check before you start to invest. Well, by the time the bonus check comes, it may not be as much as you thought. Now you got some other bills that have, or some other things that you need to commit those dollars to. And so you don't ever put it into the market, right? So I think a lot of it is just, consistently whatever it is that you believe in and then that you're getting appreciation from, whether that's, in the stock market, it's in real estate, it's in exotic cars. A lot of people are getting watches, there is just whatever it is that you believe that should be your investment vehicle, then you should strategically kind of put away either towards that so you can buy the next car, watch, stock that you're looking for, or you should be able to, incrementally start buying into that, right? And I think the other thing too is, one of the things that helped us out a lot is kind of when we moved from like, I was in corporate America for a long time and I was in finance and operations for a large company. And, we were on that kind of W-2 way, stock option grant bonuses and waiting and waiting and waiting, right? Trying to build wealth that way, as opposed to like when we became an entrepreneur and we started our first couple of businesses were kind of inventory heavy and they were things like that. And so when we shifted to this more service oriented, it kind of freed up a lot of cash and allows us to build wealth faster because we relooked at our business model in terms of and instead of holding tons of inventory and trying to do sales out that way, the service model fits us better because we free up all that cash that was dedicated to inventory. Now it's dedicated to, systems and programs and people, to help us grow the business.
Hmm. I think systems and processes helps a lot. If somebody has that, that makes you comfortable too, backing them up, right?
Right.
Because you know their experience, they've been there, they have done that before. One thing was coming to my mind, you've been sharing a lot, and then I was just thinking for every deal, there's a lot of players. And then everybody wants a stake in that, whether it's the operator, the syndicator, or the lender, or whosoever is involved, or even the property management, right? Company or whosoever is involved in that. From your
Right.
perspective, sitting on the lending side, and then are you gonna be taking the bigger leverage portion of the deal that's gonna come to you, right? So when you look at the different deals, what comes to your mind? How do you underwrite it differently than the operator or a syndicator that you think, okay, this deal makes sense for us to back it, and give even, given the track record for the operator or non-operator, because I'm pretty sure you work with a lot of people who are experienced, who are not experienced. But look, I'm looking at the holistic picture, while talking to you, that everybody wants something out of this deal, or everybody
Yeah.
looking at the same ball, like going to the soccer these days, where everybody's watching the game, so all the eyes are on the ball. So similar way, all the eyes are on the deal, like what do I make the best out of it?
Yeah, I think we look for deals that, like everybody wants a clean deal, but then everybody wants, like you were just saying, a piece of the deal, right? So then it starts to build into this layer cake, and then the person who's ultimately the sponsor for the deal and the seller, that some of their negotiations are more on how do we cut down layers out of this cake, because the transaction piece of trying to get the deal done is starting to grow, right? Just like you said. So, there may be, the final, like whoever the direct lender is, they charge a point, and then whoever the broker is, they charge a point, and then whoever the person who referred them to the broker may charge a half a point. So now we're up to 2.5 points, right? And then it kind of just starts to grow from there, to the point where some people say, well, this deal doesn't make sense. Why am I going to pay all of this up front and just points and fees? And then at the end of the day, you know, is there a better way for me to do it? So we always try and look to go with as few of those layers as possible, where there's like a lot of referral fees and a lot of that stuff. We try and negotiate that. And there has been times where, we want to do right by our client, but we're hit with a bunch of fees because this is kind of a complex, complicated deal, where we've lowered our fee, just to make sure that, we're still adding value to the deal and adding value to, the client, to make sure it gets their end goal. Because ultimately, whoever has that direct relationship with the client, they're also going to get repeat business. They're going to get referrals. They're going to get the good reviews, those kind of things. And so more often than not, we have that relationship with the client. We have that relationship with the sell side. We have that relationship with, either the commercial realtor or broker, or the residential realtor or broker, or if it's a business broker, like we've done some, business to business transactions where, they have a business broker, the seller has a business broker, we're involved. The family office that we're using has a referral person, and then everybody's wanting a piece of that, right? Just like you were saying. And so it's how
Yeah,
do we all kind of come to the table and say, okay, what makes the most sense for this deal,
for
right?
everyone. Yeah,
Yeah, yeah.
exactly, exactly.
And I
So
mean, at the end of the day, it's kind of like, guys, let's figure this out, right? And
exactly.
we all want the deal to get done, but it's not going to get done if everybody's pulling on the rope in different directions.
That's true. I agree on that. And I think the question came to my mind earlier was because you mentioned, if somebody slashed the price by 100,000. So I was just wondering, this is a follow-up question actually to this, if somebody negotiated the price to be $100,000 down or $200,000 below the price that were first offered or maybe market value. So you think is it a good idea for the syndicator or the operator come to you and tell you, okay, this was the price, this is it, or you guys check the market price and that can drive the points. You feel like, okay, there's more cushion now or there's more wiggle room and that
Yeah.
could drive the points or some interest rate there. You think?
Yeah, I mean, it does because what it'll do is it'll change the leverage a little bit, right? So
Hmm.
what it does is it allows you to um, not need as much loan for what the market value or the purchase price is, right? And so if they can come back and the seller brings back, a 100,000 to the deal, or they lower the price up front, then what we can do is then we can negotiate on our side and say, um, you know based on this, is there a way that, we can get, this for 3/4 of a point instead of a full point, right? Let's try and save some money there. Or is there a way that we can restructure the term to lower the monthly payments? And with that restructured term, is there a lower interest rate that we can get as opposed to, just a straight, hey, it's 5 years fixed and it's amortized over 25, or what, they're common, 525 deals on commercial deals and that kind of stuff. So um, we definitely try and use all points in the narrative to help the benefit of our client, right? Um, and if it benefits our client, typically benefits the whole deal. It gets the deal done, right? And that's where we go to. Really try and negotiate on their behalf, like rate and points and, calling in favors and all that kind of stuff.
Yeah, I know. I think that's a good point, but I think that's why you need these relationships, you know. If you have the stronger relationships, you understand each other better, you know, and that's gonna help you a lot. But I know a lot of people that think, you know, lender or the investor or syndication or operator relationships like kind of one-time transaction. But I think if you have a stronger relationship, you can get the better deals, you know, or better, you can work around, better work around. So, but thinking that more deeply, I was thinking, how should investors or the operators think about building long-term relationships with the capital partners?
I think they should start, if they're even thinking about it, they should start building a relationship, start that kind of interview process and say, look, um, I'm looking at a property, or I'm looking at needing capital to do a development, or I want to build, I want to invest with, these people that we know, and we're going to build this manufacturing plant, in this part of the country or something. And so you start to build those relationships early on and kind of keep it, um, keep going back to them, keep understanding them, that kind of stuff. So then when you're ready to pull the trigger, you've already got a lot of rapport with that, right? And they feel comfortable with you. And then I always say, err on the side of experience. So the more experienced of the people that you're talking to, the more rooms and access to capital and opportunities and resources you have, right? And so, um, you know, just like just like my exposure when I talked earlier about the person who's doing this, from like a uh, an insurance kind of way of thinking about it. It's like completely, I wasn't, I didn't think of that today. I mean, I'm sure there's a lot of people that did, but when he told me that, I was like, that makes 100% sense. And I totally get it. And I know why, because then the investors never really write a check, right? They get the insurance policy, and then they have the ability to borrow up against X amount and then they use that to purchase whatever company, uh, property, whatever they need. And then, the payback is not today, it's way out, and so that's the, those are just interesting things to think about. And I also think, listening to, your show and trying to figure out, different vibes from all the different guests that you have on there, there's a way for you to maybe put two and two together. So there may be something that I've said that is interesting to someone, and it may be a guest that you've had prior that they listen to that podcast and they contact both of us and say, hey, can you guys work together on a deal for me to try and figure something out? Those kind of things.
So when you look ahead over the next few years, how do you see access to capital evolving? So do relationship become even more important than they are today?
I think
I mean,
so.
like all
I
AI
think
just taking over the
I
world.
think, yeah, I mean, I don't have a crystal ball, but I think what you're starting to see in all sides of the real estate market is there's a lot of consolidations, right? So Compass and a lot of realtors have all consolidated over there. You're starting to see some banks, taking advantage of where some smaller, maybe more regional banks are struggling a little bit because the market, the interest rates are not getting enough deals through the door, that kind of stuff may start to consolidate there as well. We've seen bank consolidations in the past. And then I think, from what I hear and when I talk to my sources, there's a lot of people that are quote unquote sitting on dry powder. At some point, people are going to want to invest into people, entrepreneurs, investors, ideas, and they're going to let some of that dry powder go. I mean, I hear wild numbers from all over the place. I'll contact some of our resources, and they'll say, "Yeah, we're working with this family office, and they have 50 million in dry powder. They're just waiting for the right deal." Right. So I think at some point they're going to get tired of sitting on the sidelines, and they're going to want to start utilizing some of those funds. So I do see movement. I think the smart people are buying now to try and capitalize on people sitting on the sidelines and waiting. And so then they're going to sell. They're buying now, and then they're going to sell to those people when they think that it's time to get in, and then they're going to make all that money, right? That the equity is grown over time.
Great conversation, Aaron. We are out of time, so we're going to move on to our rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one word and one sentence only.
Okay.
And the spontaneous answers, no pressure, whatever comes to your mind first. So,
Okay.
ready?
Yeah. Okay.
All right. The first question is, what is one deal that taught you the biggest lesson?
One deal that taught us the biggest lesson is one that got away from us. It was a big deal, and we did our little kind of post-mortem after the deal that got away from us, and since then we've changed our processes and in the way we communicate some things to make sure that we stay on top of all things. So yeah, there was a deal that got away from us, and since we made those changes to our processes, I think it's helped us land more deals because of that one miss.
What is one habit that has contributed most to your success?
I would say positivity and an optimist. I'm like an internal optimist. I always think that something good is going to happen, and I don't dwell on the bad that's going to happen. Right, and I go, yeah, if we have a deadline to meet, then I'll say we're going to make the deadline. Right, not think of all the reasons we're not going to, or if there's like a something on the horizon that is a deal that we're going to land, then I feel like we're going to land it. So I definitely do keep every single day. I wake up, with a positive outlook and optimism.
That's good. And what one good book that you like to recommend?
Okay, I think probably everybody's read it before me, but I just finished Traction. So if you're an investor and or an entrepreneur, Traction is a good book. And if I could recommend one more that's kind of like it's investor related, it's very thin. My wife knows the author of it, and it's called the Richest Doctor. And what it is it's just kind of great for your investors to read about different tax strategies and stuff. It's really good.
That's good. So, in one word, what does life mean to you?
Uh, Opportunity. I think
I like
that's
that. That's
yeah,
good.
yeah.
Uh, so one last question. What is your wealth vibe?
My wealth vibe is I'm kind of looking at it backwards, right? So like think about it, think about playing golf and you're playing a hole, right? So I'm working from the green backwards where most people look at their tee shot and where do they want to go. I'm looking at where I want to end and I'm working backwards to make sure I'm hitting the milestones to get to that spot.
Great. Thank you so much, Aaron. That was such a valuable conversation. One of the biggest takeaway for me is that most successful investors do not just build wealth by finding the right deal or the perfect deal that we were talking about earlier. They build trust before they need capital. They build relationships before they need opportunities. And over time, those relationships become one of the most valuable assets they own. And that's the real investor playbook. It's not just about numbers, it's about credibility, consistency, and becoming the kind of person that opportunities naturally find. So, how can our listeners connect with you or reach out to you if they wanted to learn more about what you are building?
Yeah, the best way is you can look on our website at marshlending.com or we're on all the social channels. But if you want to get some quick hit videos and stuff, it's on YouTube at Marsh Lending. So those are two good resources.
Thank you so much, Aaron, again. And I think if there's one thing to remember from today's conversation, at least for me, is this: the best opportunities do not always go to those with most money. They go to those who have built the most trust. So stay inspired, stay intentional, and keep building your wealth vibe.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.